Welcome to Trader TV, your monthly insight into trading for professional investors. I'm Dan Barnes. In this episode, we'll be talking to Jim Switzer, Global Head of Credit Trading at AllianceBernstein, on the effect of a sell-off in the corporate bond market and how the trading desk adds value during that process. I will also update you on sell-side trading desk activity this quarter. We're going to talk now to Jim Switzer, Head of Credit Trading at AllianceBernstein, about the corporate or credit markets. Jim, welcome to Trader TV.
Thank you, Dan. Thanks for having me.
Thank you for coming. So, if we look at the activity that occurs during a sell-off, if you're on a trading desk, what are you actually seeing on your screen? What's coming through on the telephones? How are you engaging with the market at that point?
Look, in a severe market sell-off, you're just watching a lot of offers and you're not seeing a lot of bids fill in. And that's where what we tend to do in those sell-offs is we start to look at our liquidity positions and our portfolios, and we've had those in there for very specific reasons, for times like that. So when we get to points in the market like this, we begin to, let's say, move out of cash bonds and into more synthetic securities, whether that's index or whether that's total return swaps or some kind of derivative product, that we have greater certainty of liquidity there. So as traders, we really start to think about the portfolios, the flows that we're seeing, and what are we going to have to do next. It's also when our relationships, the sell-side relationships come into play, and that's where we're going to be using the dealers, what limited balance sheet they will provide, but more importantly, the knowledge of the market and knowledge of the potential buyers and sellers. We're going to be tapping into that to try to move whatever we possibly can. Okay. People are starting to get concerned with if there's something on the horizon that startles the market and creates a wave of forced selling, what will the liquidity look like for us at that time? And
so for a trader who's engaging in the market at that point, what would you say are the greatest challenges that they need to overcome?
Pre-trade transparency. That's the greatest challenge we have in times of stress and non-stress. We're talking about a market, a large percentage of it that doesn't trade on a regular basis. There's not a lot of confidence around the liquid parts of the market. And even in the more liquid parts of the market, during times of stress, transparency is very, very poor. So I think what we're doing on the AB trading desk is using technology or using anything we can to get a better view into the market to where real risk can move.
Okay.
Look, we've seen reports, many reports. The Fed, I believe, put a report out also where they talk about bid-offer spreads and how bid-offer spreads are back to pre-crisis levels. I don't believe that. I believe optically we are there, and I believe when you look at a bid-offer spread that you see that, but the amount of risk that we could move on the bid side or on the offer side today versus pre-crisis, there's no comparison. And that's what we have to recognize. So the market, when it gets stressed, it will really be that bid-offer spread that starts to narrow. Because look, liquidity, it has to cost something. If we want immediacy, and if we want size, there's a price for it. The question is, what's the price?
You mentioned about using swaps and other non-cash instruments in this situation. To what extent can those tools be used to take risk on and off? And what challenges are there around using non-cash instruments in a sell-off environment?
Well, some of the challenges are we have clients that are not comfortable with them and don't want them to be in portfolios. But many of our clients and many of our portfolios, we can use them.
Okay.
And look, we use them when we think it gives us an edge, when we think that there's liquidity or return to be gained. We're trying to do many different things right now. One of the things that we're seeing as a result of the move to passive momentum investing, or the ETFs, is that's creating alternate sources of liquidity. And we call them portfolio trades, where we actually have sell-side counterparties that can come to us and say, hey, we want to buy a large block of risk, diversified block of high yield risk, let's say $500 million, and we can pay mid-market. So we could look at a trade like that, and maybe we want to shed risk from our portfolio, so we'll engage in that. Or maybe we want to liquefy the portfolio, so we might sell that cash and roll that into TRS, which we think is a better place or a more diversified place for us to be able to sort total return swaps.
Thank you.
We could do that versus crossover, CDX, iTrax, whatever that might be. So there's a lot of ways that we're looking at doing those trades. The problem is these are new markets and they're difficult to put together in a timely fashion. So a typical portfolio trade, and we've done some very large ones, they might take us 4 hours to do. And our goal is to get that down to under 30 minutes because, look, at a time of dislocation in the market, speed is of the essence. Yeah. And going back to what I talked about before, being a liquidity provider at that moment in time is really going to drive performance, and that's what we're trying to set up for.
Sure. And you mentioned technology as well. I just wanted to unpack that a bit. What sort of data sources can somebody use in an over-the-counter market like fixed income, and how can you bring that together on the trading desk as you've done?
Look, information, in the credit markets is so bifurcated, and it's coming from so many different sources. I believe somebody told me we get 3 million messages a day coming into the firm that we have to somehow be able to read or make some sense of. When you think about AllianceBernstein and you think about the trading desk, the things I like people to think of is the people. Mm-hmm. We've changed the traders. We brought in risk takers, relative value experts, and people with experience that have been through some of these illiquid markets. But the secret sauce is our investment process. It's a very integrated investment process. Traders, portfolio managers, and analysts, both fundamental and quant, all have a seat at the table, mm-hmm. and are all talking about it. But more importantly, from a trader's perspective, it empowers us to be able to speak of the risk appetite of our firm. And that's a huge edge out there. When markets are dislocated and we see opportunities, we can get those ideas into portfolios very, very quickly. We want liquidity to be front and center, discussing it as we're making decisions, investment decisions, and as to what's this going to cost and what's the outcome and how are we going to source it and can we even do that. So now you look at the people, you look at the process. The one thing that we couldn't handle is there's too much information coming in from too many places, and that's where we had to lay the technology on it. And that's when we created our Alpha tool.
Okay, that's great. And so that brings all that information together to assist with the trading process. And it's interesting then, if you're in a sell-off environment, how does that communication work between the trading desk, which you've described before as being the tip of the spear, and the investment management process? Because there must be an enormous amount of communication going back and forth.
Yeah, I think the interesting, if you come to New York or to our London offices and you look at the trading desk, the PMs sit right there with the traders. Right. They're not in offices. So when we're in those volatile markets, we can get answers very quickly. We pride ourselves that if we see an opportunity in the marketplace, we can turn an idea around in less than 10 minutes. And when markets get more illiquid, we try to do it faster. Wow. But oftentimes the PMs are pushing a lot of the responsibility down to the traders to make a determination of what they think we could buy or what they think we can sell. Mm-hmm. And it works pretty well. The technology we have isn't just on the trading desk. It's on the portfolio manager's desk, it's on the APM's desk, it's on the research analyst desk. It's really part of the DNA of our firm, and it's used by everybody in many different ways. So that also helps tie it together, and we all speak the same language.
That's excellent. Thank you for explaining that. And so if we were to bring that back to how the trader is adding value to the investment process during a market sell-off, how would you encapsulate that?
In a lot of different ways. One, we're talking to the portfolio manager, and we're giving him very, very important market intel, mm-hmm. and ways that we think we can navigate around a liquidity bubble in a particular sector or just sectors. It gives us the ability to talk about mispricings in the market where we see maybe it's synthetic start trading cheap to cash or vice versa. These portfolio trades when ETFs, which we don't really know how an ETF, a credit ETF, is going to trade during a really, really volatile time because they haven't been around. Yeah. So it's that trader that's able to say, look, I can source liquidity 500 million or $1 billion, and this is the opportunity. We've had many examples where we've had portfolio managers come to us and say, we just want to take down our energy risk. And it's really up to the trader to kind of guide him to where he thinks the most liquid parts of his portfolio are. As a trader, we're also out there looking at different parts of the curve. Where are the better roll down points? Where are the better opportunities? In banking space, we're looking for what part of the capital structure offers more value. And look, this is where our analysts are, because we're very, very plugged in. You show me a great trader, he's got to have a great analyst, and vice versa. And at AB, that's a big part of what we do, is we partner up with our analysts. We know what their views are, and we're out there assessing relative value and where the opportunities are, and then delivering that message back to the portfolio manager.
Jim Switzer, thank you very much.
Thank you.
Next, we're going to look at the sell side of the market to get an idea of how the counterparts to buy-side trading desks are faring. Analyst firm Coalition reports that banks have seen a decline in revenues across fixed income, currencies and commodities, or the FIC sector, and equities. This decline is expected to continue in Q4 2017 due to a lack of macro volatility and lower results in fixed income. FIC investment bank revenues underperformed across all products and declined across regions: Asia Pacific, Europe, Middle East and Africa, and Americas in Q3, with larger declines in the Americas and APAC. The EMEA region benefited from several large inflation transactions and stable revenue in cash products. The Americas declined due to lower results in both flow products and US dollar structured notes. Repo continues to outperform other products, even though revenue had the first quarterly decline in the Americas since Q2 2015. Weak performance was seen in investment grade and high yield amid tighter spreads and lower volatility. Coalition reports that this was offset by improved performances in structured products, such as collateralized loan obligations, even though performance slowed down in Q3 2017. Regionally, Americas and APAC declined more than EMEA. If we then look at headcount on the sell side, a fairly constant decline over the last 6 years has slowed to a near plateau in the last quarter. Coalition reports this was largely due to some select hiring in the corporate bond space, while other areas saw small declines in headcount. In January on Trader TV, we'll be covering the impact of MiFID II across markets, which will separate out the payments for trading and research in Europe across all asset classes. In fixed income, the expectation is that despite that separation, we will see spreads widening, increasing the cost of trading and making life harder for traders. For now, I'd like to thank our guest, Jim Switzer of AllianceBernstein, and you for watching. Join us again in January for Trader TV. We hope you have a great Christmas or Hanukkah, and we will see you in the new year.